Welcome back to our Diwali special on ET Now, and this is the segment called Fantastic Managers. And joining us today on the show is, of course, Mr. Mahesh Patil, the CIO at Aditya Birla Sun Life AMC. Mahesh, thanks so much for dropping by and wishing you a very happy Diwali.
Yeah, happy Diwali to you and all your listeners.
And is it going to be a happy Diwali? You think so?
Yeah, should be. Though I think the start has not been that great, right? Because the earnings season has been a bit volatile. We've seen a couple of disappointments over there, and markets. I mean, some of the stocks have reacted very negatively over there. But I think that's what Diwali is all about, right? It's always some amount of spice. But I think overall macro stability is there. So I would say that there was a much needed correction in the market. We have seen a one-way rally in the market in the last 3 years, right?
Yes.
So I think that's a welcome kind of this thing. Some kind of a reset of expectations is what we are seeing at this point in time.
I think that seems to be the consensus, that the expectations need to be reset this year. But let's bring up the first question that I wanted to ask you, and that's about which is going to be the best asset class as per you when it comes to Samvat 2081. Of course, Indian equities are a favorite and are biased, but gold has done rather well this year. And global equities in terms of US, China, etc. are looking attractive. And of course, debt as well, because likely to make a bit of a comeback.
So actually, if you look at on a risk-adjusted basis, if you look at it, all the asset class looks fairly well balanced, right? But if you really ask in pure absolute returns, I would still believe that Indian equities, right, would still give you good returns because, yeah, we have seen some kind of a correction now, okay, around 5-6%, 7-8% correction. And looking at while this year, okay, we have seen some kind of a moderation in terms of earnings growth, okay, from. But I think next year, I think you should still be, I think Indian economy will continue to grow at a reasonable pace, right? So my bet would still be around India, at least around say 6.5% is what you would expect. So Indian equities will still be good. I think gold also, I think, has done very well this year, right? Almost like 30% kind of a return. Should continue to be reasonably well, but I would put my money again on Indian equities.
Okay, putting money on Indian equities, but what kind of return expectation when you are putting money into the Indian equity markets? Because we started the conversation by saying there is a reset of expectations which is needed. Last 3 years, as you pointed out, return has been at an average of 18-20% versus the average of 12 to 14. Somewhat 2081, next 12 months, what should be a realistic expectation from Nifty?
So I think if you look at the Nifty per se, if you look at the Nifty in terms of what is the factors which will drive the return. One is the earnings growth. So I think earnings growth trajectory, I think while it was growing earlier at around 20% CAGR for the last 3 years, okay, we would expect that to grow at around say around 12 to 13% in that region, or slightly low. If you take at FI next 2 year CAGR, this year will be slightly lower, probably in the high single digit FY25. And valuations are kind of reasonable. I mean, Nifty, if you look at per se, right, what it was around 5 years back, it's somewhere in that region. So I would say earnings growth is what the market should return, which should be in this 10 to 15% category, I would say. Yeah.
But yeah, earnings coming down to 12 to 13%, you said, versus 20%. So that, of course, will have an impact. But that is going to be the big risk for the markets, you believe? Do you see a question on that? Because valuations, you said it's in a 5-year range, but we are at the higher end, 21, 22 times than what we have seen. And if you look at the mid-cap and small-cap indices, it's much higher than the average. So is that a risk, or the geopolitical tension, or what do you see as the biggest risk for the market, you would say?
So amongst all these, I mean, macro economy is still fine, I think. Right? India's macro stability, I think, is there pretty much. I don't see any challenges over there. Valuations are slightly on, especially I think this on the mid and small cap. Right? Nifty, as I said, what the multiples were in FY19 pre-COVID, we are somewhere in that regions.
Yeah, because earnings have been able to catch up to that.
So I don't see, if you're looking from a market mean, if you look at Nifty perspective, I don't think that's such a big at this point in time. Geopolitics continues to remain, but I would say earnings growth, because that's where at least in this quarter, we have seen that, right? There has been now some amount of volatility in earnings. We have seen some downgrades to earnings. And there is some slowdown, right? Compared to expectation, what we were growing in this thing, at least on the consumption side. So if that, again, doesn't really recover, and that depends on the policy environment, what RBI does in terms of interest rate, I think that could be a risk from a market perspective, because if earnings are fine, I think higher valuations can always be justified. Yes.
True that. But let's move on to the next one, and that is a very interesting one as to where you would put incremental money if you were a mutual fund investor, which I'm sure you'll advocate for. Last year we saw a lot of NFOs and the thematics coming in. There were a lot of other issues that also came in through. But next year, what's the best strategy?
So I think again coming back, large caps. Okay, we think that again, if this is a time where you want to protect your gains also, right? I mean, last 3 years has been, so you want to look at an asset class within the equities where the margin of safety is much better,
higher.
right? And you also want to move on better quality. So investing in the blue chip large cap names which have not done as great. If you look at a lot of companies there, large top companies in the last 3 years not given that great returns, and valuations, as I said, is not cheap but kind of
Not
reasonable,
expensive
right?
either.
So I think it's, and again the asset allocation shift which has happened in the last 3 years to more towards say mid cap and thematics, that also need to be rebalanced. So from a risk reward perspective, I would put money into the large cap space, yes,
And within large cap, if I had to ask you, get a bit more sector specific, because A, there are spaces where momentum is strong. Do you stick with that? Do you be with the underperformers? Or there's a larger theme that you have at play? So these are some of the options. Tell me, what is your pick here?
So I think the momentum game which was being played in the market in the last 3 years, I think that is now kind of turning around a bit, right?
Okay.
So high momentum, high growth, high beta stocks, I think that is changing now. And as I said, one wants to also protect the kind of looking at the margin of safety. So I would look at a sector which has kind of underperformed, right, where valuations are reasonable and can have a reasonable kind of where the ownership levels are also much lower. So from that perspective, I would say financials, no? Especially the private banks, okay, which have kind of underperformed because of a lot of regulatory oversight which has been there, right, and a lot of some concerns, okay, on the asset side. But I think the high quality private banks, I think will do well. I think you will see some recovery on the corporate credit growth, okay, while there is currently some slowdown over there. But looking at the valuations and the fact that it has underperformed and under-owned, especially from the foreign side, I think I would put money into the financial, especially the private banks.
You talked about the foreign side, Mahesh. I just wanted to get more perspective from you on that one, because the FII flows have been rather stark this year. I mean, 1 lakh in this month itself, 2 lakh crores in this year. From that perspective, what will turn the tide for them, you think? Because earnings we were doing good off from the start of the year itself. Valuations were all right again because it could be justified as per earnings. Now with the tide turning, is the outflow just going to continue?
So I think FIs have been slightly worried, I think, in India on the valuations. I mean, that was the concern, because when they look at India vis-a-vis the other emerging markets or global markets, it looked slightly on the expensive side. So I think some kind of a time correction in the market, or some correction in the market, what we are witnessing, I think will give them an opportunity to then look at India, because I think fairly, I think they are pretty much sold on the India long-term story, right? So while there is some trade-off currently, because in the short term you could have moved money into China, right, which was kind of it was undervalued, underperformed, and also some stimulus, okay, by the by the government over there. But that's a very tactical kind of a move. So I think a correction in the market which at least addresses the concern about valuations, I think a 10% correction is a good entry point for them to come back and look into some of the stocks and to buy. Because I think structurally, I think the ownership now in Indian equities is at the lowest level. Right. If you look at in terms of the benchmark in the MSCI emerging market, traditionally FIs have been overweight by around say 3 to 4%.
Is that around 9-year low or something?
Yeah, it's a 10-year low. It's like they are now probably equal weight or slightly underweight. So I don't see they will want to go underweight from here, right? So I think given that, I think if any correction in the market further, I think you will see buying coming in from the FIs.
Given that markets have still not corrected 10%, there could be some more correction.
We're already 8-9%.
They're already 6-7% down. So I'm saying 10% just a number which I'm putting it, but I think that's a decent correction.
So you expect market to consolidate for at least some more time then?
Could be, yes. I think we are in that phase of consolidation or some reset in terms of earnings, and at least the breadth of the market is continue to weaken, right? And that's what you've seen, especially after the election results, right? Since then, in the last 4 to 5 months, the breadth is weakened. So while indices are not down much, I mean 6% to 8% if you look at whatever.
Portfolios are much
weaker.
But
stocks are down significantly from their all-time highs.
So mentioning about stocks that are down significantly from their all-time highs, PSU is one basket which has declined, and specifically the defense and the railway space. Now, in the first half of this Samvat, PSUs were the talk of the town. And right now, if we see, they are down nearly 40-50% from their recent highs. So, do now the valuations look a bit more better when it comes to the PSU basket of defense and railways?
Again, this is a very, very narrow, if you look at defense and railways, obviously compared to historical level, because some of these stocks are looking much higher, because these sectors were totally out of favor, right? There was not much happening in the sectors Obviously, there are some structural drivers in this space because of the spendings or whether India is trying to do more sourcing from domestic in the defense side. So clearly, you can't compare these stocks vis-a-vis historical because the narrative, the outlook there is much better. But the valuations clearly are still a bit stretched over there. And again, you might see some execution delays over there, right? We saw that because when there is over expectations are there, people already factor in the next whatever future into the current. But I think you will see some execution challenges over there, and that would mean that you might see some kind of a more drawdowns, okay, over there. But I think I would still believe that the valuations are slightly a bit stretched in these. But by and large, PSUs, if you look at, there are other sectors like utilities or on the oil and gas side, which are not as expensive, right? So PSU, generalizing PSUs as being expensive would not be all that. Though they have outperformed, but we have also seen the companies doing much better, and some of the companies, PSU companies, their profitability, the way they are managing their listing balance sheet, and also deploying capital, right? Capital allocation is much better than what it is in the past. So there is case for some re-rating than what it was there, say, around 5-6 years back.
Okay. And if you compare from last summer to this summer, the FMCG is also one space which has not outperformed the market. The returns are the lowest, in fact, if you look at compared to other sectoral indices. So, and given the fact that second half is expected to be better when it comes from consumption perspective, consumption is expected to pick up. So, do you think FMCG could be a good basket for investors to put in their money, or are the valuations still on the higher side when it comes to this FMCG sector?
So FMCG, actually there was expectations, right, leading into this festive.
Election,
you will see, I mean, it has underperformed because rural economy was weak. We have seen some pickup in rural, monsoons were good, and so I think its second half would be important, though it has still been disappointing results. Festive season, at least the last quarter in terms of volumes were. But more than FMCG as a consumer basket, I think that slightly more discretionary consumption is where I think would be better from a slightly more, because there the growth and the recovery, if you see, could be much better over there. Consumer staples are also facing some challenges, okay, from the D2C brands, and there are certain categories where we are seeing their market share is getting a bit impacted over there. And so I would say that after the recent correction, I think it could still be a reasonable defensive, but I think the growth would still be a challenge over there, right? It might not, I mean, getting a double-digit growth will be a challenge.
Just a follow-up there, sorry to interject there. So earlier, last couple of years, it was all about the K-shaped recovery and how the urban end of the world was doing well, and we were all waiting by for rural recovery. Now even urban is showing signs of slowing down. In that context, all these stocks, let's say real estate and the luxury good ones, would you bet on them as a multi-year trend, or would you stay away from them right now?
No, I think the trend clearly is there, right? I mean, if you look at in India in terms of per capita income going up, I mean, structural trend toward discretionary consumption, and the young India is more aspirational. So we have seen the premiumization trend, which has been there across, whether it's in the auto side, whether it is consumer durables on the real estate side. I think that is going to continue. I don't see that as a challenge. In the short term, okay, you will see some kind of exhaustion over there. Right? They've done very well in that sense. But I think that premiumization trend will be a longer term trend, I think, which will continue, I would say. Yeah.
And sir, before we let you go, let's go across to the wheels of fortune here. If you could just come across here. So we'll just roll this, wherever it lies down, you'll have to answer. And the first one, okay, it's a multi-bag idea. You don't need to give a stock name. You can give a sector name other than financials, I guess you mentioned.
Yeah.
Other than financials.
Yeah, I think multi-bagger at this point in time, where the market is, I would say, looks difficult. Difficult to foresee anything a multi-bagger. But stock specific, I think market is going to be more stock specific now.
Right.
And big macro themes have played out to a large extent. So I don't see any, but I think you'll always, for a stock picker, and there are always multi-bagger ideas which are there.
Right. So any sector other than financials?
I would still believe that in the consumer discretionary retail is where I think we have seen kind of a slowdown. Where the digital
transformation is taken over.
Yeah, where digital transformation is there, and where the growth, right, longer term growth trajectory could be much better, because and that's where I think the near term concerns about growth, I think if they are able to come back normalcy, I think these are sectors which are traditionally been a high growth sector, which you could potentially see a earnings growth recovery as well as PE rating.
Okay. Let's.
I hope it doesn't come back the same one. Okay.
No.
Nifty
we talked about that, right?
About that.
I mean,
so you can
in that
answer
range.
Okay, this is also talked
the learning
about.
from last year, what would you call that?
So I think learning from last year would be that clearly I think in last year everything moved up.
Yes.
Right. Risk taking was getting rewarded disproportionately. Right. And it was easy to make money. Right. But I think the learning is that now we've seen that. Right.
The easy era of money making is
now over. Okay, you have to be really careful because I think as liquidity gets withdrawn a bit,
Right.
and as we see the momentum is slowing down earnings, I think it has to be much more discerning and really looking at your fundamentals. I think coming back to fundamentals is what I think we are likely to see going forward.
Okay, fundamentals and capital preservation, that's going to be the theme next year. Thanks so much, Mahesh, for dropping by and speaking with us today. With that, we'll slip into a very short break, but don't go anywhere. Lots lined up when we come back.